The Modigliani-Miller M&M theorem is the law of conservation for finance. In a perfect world without taxes, it argues that how you slice the financial pie doesn't change the size of the pie itself. To understand this intuitively, let's look at the two core propositions using Merton Miller's own favorite analogy, a pizza. 1. The pizza analogy. Proposition 1. Imagine you order a whole pizza. The pizza represents the total value of a company. The slices, you can cut it into 4 large slices, equity, or 8 small slices, debt plus equity. The intuition, whether you cut the pizza into 4 pieces or 100 pieces, you still have the same amount of dough, cheese, and toppings. Proposition I states that the total value of a firm is determined by its underlying assets and the earnings they generate, the pizza, not by the mix of securities it issues, the slices. If the business is fundamentally worth $1 million, it doesn't matter if you fund it with 100% equity or a 50-50 mix of debt and equity, the total value remains $1 million. 2. The no free lunch rule. Proposition 2. You might think, wait, debt is cheaper than equity because lenders take less risk. If I use more cheap debt, shouldn't my overall cost of capital go down? Proposition 2 says no. Here is the intuition. As you add more debt, the company becomes leveraged. Lenders, debt holders get paid first, leaving the remaining cash for shareholders, equity holders. Because debt holders are ahead in line, the shareholders now face a much higher risk of getting nothing if the business has a bad year. To stay invested, shareholders demand a higher return to compensate for this extra risk. The result: the benefit of using cheap debt is exactly cancelled out by the expensive increase in the required return for equity. Your total cost of capital stays exactly the same. 3. Why this works. The arbitrage argument. The real magic behind the theorem is homemade leverage. If a company tries to trick the market by taking on debt to boost its value, an investor can simply replicate that same risk-return profile on their own. If a firm is unlevered, no debt, an investor can borrow money personally to buy its shares. Because the investor can create their own debt at the same rate as the firm, they won't pay a premium for the firm to do it for them. In a perfect market, the do-it-yourself option ensures that the price of the prepackaged version, the levered firm, cannot stay higher than the raw version, the unlevered firm. Key assumptions. The perfect world. For this to hold true, M&M assumes 1. No taxes. There are no tax breaks for interest payments. 2. No bankruptcy costs. Going broke is free and doesn't destroy value. 3. Perfect information. Everyone knows everything about the firm. 4. Equal borrowing costs. You can borrow money at the same interest rate as a giant corporation. Summary table. Feature. Traditional view before M&M. M&M intuition. No taxes. Firm value can be increased by finding the optimal debt mix. Is fixed by the quality of the company's assets. Cost of capital decreases as you add cheap debt. Stays constant. Equity gets riskier as debt is added. Analogy. Adding more dough to the pizza. Just slicing the same pizza differently.